and welcome again to Hidden Truths. And today we have Bob Barone, who is going to give us an update on CPI. We just had a recent CPI update. Bob, how are you today?
I'm good. Yes, and we did have a CPI and a PPI, and it looks better than we thought.
Good. So the CPI came out Wednesday, right? It only rose about 0.1% in March, and that's down from 0.4% in February and 0.5% in January. So then on Thursday, producer prices fell at 0.5%. What's your take on that, Bob?
If you actually look at the CPI, the press reports zero point 0.1, but the actual number was 0.053 to the third decimal. It's really only about half as much as the zero point 0.1, so that's even better news. The media only reports one decimal place. They round it up or down. It's really pretty good news. The producer index really shocked everyone to the downside. It fell 0.5%, and the markets were expecting no change at all. And if we look at the core of the producer price index, that's X food and X energy, it fell minus 0.1%. The consensus thought that it was going to rise 0.2. So
Mm.
this is really good news on the inflation front. So back to the CPI. The low number there actually occurred with the shelter component, that's rents, coming in at plus 0.6%. And while this is the lowest the shelter component has been in the CPI since a year ago, April, we know from the private sector sources like Zillow that rents are continuing to contract. Shelter has a weight of about 33% in the CPI calculation. The way that the Bureau of Labor Statistics calculates rents has a lag of about 6 to 8 months. So that's what I say. Well, they were up 0.6%, but we know that they're falling. And if we just play some games and do some assuming. Let's assume that they actually were flat. They didn't go up at all. If that were the case, then the CPI would have been negative 0.2, and not plus, but negative. And the year-over-year rate, which fell to 5% in March, would have actually fallen to 4.75. Let's be really realistic. As you can see from the chart that we have from Zillow, the rents have been falling for over a year. And we now have rising vacancy rates, and we have a record number of apartments under construction. So rents are going to continue to fall for the next, as far as we can see, until all of this reverses. Let's just play devil's advocate and pick something realistic. And looking at the chart again, let's just say that rents actually fell 0.5% in March. If that were the case, then the CPI would have been minus 0.3%.
Yeah.
Remember, we're all excited that it's only 0.5.
Right.
Minus 0.3, and that annualizes to minus 3.3%. So you see, both from the CPI point of view and the PPI, we really have deflation already starting.
Right. Yeah. You mentioned that in your prior blog as well. Do you think that as a result of the CPI and PI reports that the Fed will not raise rates as its May 2nd and May 3rd meeting?
Unfortunately, the Fed doesn't look at the headline rate. They look at they have their own way of doing things. And they're telling us that they're looking now at service inflation. They're not looking at goods inflation, which is deflating now. For example, in March, airline fares or service, they rose 4%. And hotels, motels, in March, they rose 2.7%. So we still have some service inflation, and that's what the Fed's looking at. In fact, they call it core services X energy and rent, and that rose in March 0.4%. And basically, that 0.4% is similar to increases that have been going on in that index or that sub-index since last August. So it's a long time that we've had that kind of inflation in services. The year-on-year number there is plus 5.8%. A year ago, it was 4.8%. So if they're really looking at this, they're going to raise 25 basis points on May 3rd. But expect that when they have released their statement and have a press conference, it's going to be somewhat dovish.
Mm.
If we have another month or two of the CPI and the PPI doing what they did here in March, then likely the 25 basis points that I think they're going to do here in May will be the last rate hike.
Okay, all right. Good to know. So in mid-March, we had quite a scare with two big banks failing, right? Silicon Valley Bank and Signature Bank both failed on the same weekend. Things seem to have calmed down a little, but what happened really? And is there any fallout still to come? Do you anticipate any fallout yourself?
Yes, I think that we should assume that everything is okay. We're going to have lots of fallout from what happened here in mid-March. Okay, let's talk about Silicon Valley Bank first. They had a huge portfolio of treasury securities that they had purchased before the Fed started raising rates in 2022. Fed, remember, had held rates really low, and it was probably for way too long that they held them low. And so the coupon rates or the returns on those bonds were quite low. Okay, they could do it at the time because they were getting demand deposits that they paid nothing on. So if they got 1 or 2% on bonds, that was a pretty good spread.
Mhm.
So now that the Fed has raised the rates so much, the market value of those bonds was way below what Silicon Valley Bank had paid for them. And so much so that if they actually marked them to market, their capital would have been completely gone. So they knew that. And so they announced that they were going to raise more capital. And when they did that, remember, Silicon Valley Bank catered to tech startups.
Right. Yeah.
And, and most of those guys, when they do a startup, they get millions of dollars
Yeah.
and they put it all in Silicon Valley Bank. Remember, the FDIC insurance limit is 250,000. So
Mhm.
all these startups had a few million in that bank.
Yeah.
So when those clients found out or heard that new capital was being raised, and then they had one of their own, Peter Thiel, urging them to take the money out, he actually caused the run on deposits. Okay, the way a bank works is they borrow money. It's called deposits. It's really borrowed money. People put their money in the bank. On the bank's balance sheet, it is a liability. It's a deposit. So it's a borrowing in effect. And they keep some of that fairly liquid because, some people the next day or the day after need some money and they write checks. So they keep some of it liquid. But normally it's not much and they invest the rest because not every depositor wants their entire balance all on the same day. Under normal circumstances, a bank can invest a high percentage of those deposits in loans and investments like bonds.
Mhm.
That's how they make their profit because they lend out at higher rates than they pay on the deposits. When the run began on Silicon Valley, they tried to borrow money from the Federal Reserve and from the Federal Home Loan Bank. Unfortunately, they couldn't get the borrowing done in time, either because their paperwork wasn't up to date and or it was too late in the day and the government employees want to go home instead of fixing the problem.
Mhm.
So they had to sell down their bond portfolio. There are accounting rules, okay? There's an account called held to maturity on a bank's balance sheet. And that's where they put bonds held to maturity. When they put them in held to maturity, they do not have to mark them to market. In Silicon Valley's case, even though the bonds had gone down in value, they didn't recognize that on their balance sheet because they don't have to because they're held to maturity. But the rule is if you sell one bond out of held to maturity account, you have to mark them all to market.
Mm.
So they couldn't get any money from the Fed. They couldn't get any money from the Federal Home Loan Bank.
Yeah.
So they sold bonds out of the held to maturity account. And as soon as they did that, to meet the deposit run, they had to, the accountants would mark those bonds to market and they would be negative capital and insolvent. And that's what happened to them. The Fed stepped in, and knowing that this has occurred in other banks besides Silicon Valley, they set up over the weekend that the Silicon Valley jailed a special lending facility with special rules that said that they would accept those held to maturity bonds at their face value instead of at their market value and lend banks the money against those bonds. So with this new facility, now other banks had the ability to turn those bonds into cash without having to mark them to market.
Mm.
They didn't have to take a loss on their balance sheet and reduce their book capital.
Right.
It's really true, though, that most of them probably have suffered a loss of real capital if they actually had to liquidate all of their assets.
Yeah.
Other small banks also suffered runs in the aftermath of the Silicon Valley Bank issue, but the fact that they could get all the liquidity they needed from the Fed without having any accounting impact on their capital actually saved the day. And as I said, the reality is that if they had to mark them to market, we would probably see a few more failures.
Do you anticipate any continuing fallout from these runs? And what impact will this ultimately have on the banks and on the economy overall?
Most of the panic from mid-March it seems to have dissipated. We don't see any more headlines about the bank runs. But I will caution everybody who's listening to this that most of the real fallout still lies ahead. And that's when the banks are now moving into restructuring mode, which means they're looking at their loans, they're looking at their other assets, and they're tightening all their credit standards. When they do this, this is only going to deepen the recession. As I said earlier, the banks, when they suffered the runs, had to borrow money. And in fact, when we look at the Fed's balance sheet, we see that there are more than $350 billion of new loans out to the banks. Now, let's look at they're pledging these bonds that they bought in before 2022, which pay 1 or 2 or 3%,
Hmm.
and they're borrowing at 5%.
Yeah.
Their profit margins are going to shrink because it's actually costing them a significant amount of money to have the liquidity. In addition, most of the banks in the regional and small bank communities had already begun to tighten their credit standards even before the Silicon Valley Bank issues occurred. And now, because of that, they're tightening those lending standards even more. And especially because these little banks have a lot of commercial real estate loans. There's a chart here that shows what percentage these banks have, and it's more than 40% of their loan portfolio is in these commercial real estate deals. There's been a lot of articles over the last month or so about high vacancy rates in office buildings. People have learned how to work from home. We have technology like we're using right now, Zoom, that makes it easier to be at home and still talk to your colleagues, etc.
Mhm.
And there's huge vacancy rates in office buildings. And we've seen foreclosures occur, some high profile closures in California and in New York City. So this is simply going to impact banks' earnings, and we're going to see them have to increase their loan loss reserves. And because of all this, whenever that happens in banks, as a former banker, I know for sure when that happens, all the credit standards are tightened, and you try not to lend any more money out for
Yeah.
fear that you're making another big mistake.
Of course, no, it creates a lot of tension. Yeah. We also had a job report last Friday, and the unemployment rate fell back to 3.5%. Does this mean that the labor market is still hot?
So my answer is no, the labor market is not hot. In fact, it's cooled quite a bit, even though the, the outward or the high profile numbers don't show it. And last Friday, that labor numbers came out. It was Good Friday. It was a market holiday, but the numbers came out that day. So there wasn't any real time reaction to the jobs data because the markets were closed. Payroll data came in at 236,000 positive. 236 jobs were created. The street estimate, I've never seen one this close, 238,000. So it was dead on the street's estimates. And so there would have been hardly any market reaction anyway.
Mhm.
And so on Monday, when markets reopened, there wasn't much reaction. Earlier in the week, before the payroll survey, ADP, which also reports its own numbers, reported in their survey job growth of 145,000. That was down almost 50% from their February 261,000 positive count. ADP said we see rapid tightening in the loosening in the labor market. We also had a report called the JOLTS, Job Opening and Labor Turnover Survey. That's a monthly survey. And for the first time since May of 2021, so that's almost 2 years, job openings and that report were below 10 million, and it was down by 1.3 million over the past 2 months. That's huge. In addition, new hires in that report were at a 21-month low. So that shows that at least at the margin, we're seeing quite a shock
Yeah.
beginning in the labor markets.
Right.
Fed Chair Powell has referenced this JOLTS report several times in his press conferences as a very important indicator that the Fed looks at. Now, we did see the unemployment rate drop by 0.1 percentage points back from 3.6 to 3.5. This occurred because there's a sister survey to the payroll report called the household survey. And that household survey is the one that calculates the unemployment rate. And that household survey showed a little faster jobs growth than the payroll survey. Clearly, jobs, at least in the Fed's view, are still in the plus column. This is going to keep, at least in my opinion, the Fed is going to keep tightening. But in reality, if we actually exclude the COVID lockdowns, we actually see um, that March's payroll number was the slowest since February of 2020.
Yeah.
And that shows that the labor market is just, and I think it's precipitously, very quickly cooling.
Looks like it. Yeah. Are you worried about any other data in the job sector?
I think, as you can tell from what I've been talking about, most of the labor data says that we're really at the beginning of a recession. Average hours worked per week fell, not much, 1/10 of an hour from 4.5 in February to 34.4 in March. It doesn't seem like much, but when you multiply it by the hundreds of millions of employees, it's a huge number.
Yeah.
Outside of COVID, this is the lowest number of work week hours since all the way back in September of 2019. So, what do I make of this? It costs a lot of money to hire and train employees. And so, the first signs of cooling economy is when employers say, gee, we're just not making as much money. So let's not work as many hours, especially if we pay people by the hour. The first thing to be cut is hours.
Mm.
The next thing that's cut is heads. So hourly earnings rose 0.3% in March and have risen 4.2% over the past year. So there's a chart here that shows negative trends again. And it shows that we are now in the slowest period since all the way back to June of 2021. The annualized 3-month trend is even lower, 3.8% year over year annualized. This is really good news for the inflation scene and is pretty solid evidence that we are not in a wage price spiral. But worry about at the one that we're in the 70s.
Mhm.
By sector, if we look at the data and we see from the next chart that I have here, that the rise in the jobs was from the usual suspects, the leisure and hospitality community, healthcare, and government. Note that the items that really lead the economy, construction and retail and the financial and manufacturing, those all had negative job growth in March. And they're leading indicators of where the economy is going. Now, you'll note from this chart that the financial activities showed up as minus 1,000.
Mhm.
This survey was taken prior to the Silicon Valley Bank issues, and uh, and uh, and as a result, I really expect the official payroll data next month is going to show a large negative number in the financial sector.
Okay. Right. Yeah. Do you agree with the market view that if the Fed raises rates at the May 3rd FOMC meeting, it will be the last raise?
That's my view, not because I think what they're doing is good economic policy, but that's my reading of these folks who sit on the Federal Open Market Committee. And there's a predominance of evidence that shows not only a weakening economy, but the fact that we're now entering a period of, let me call it disinflation, that I think could turn into deflation quite
Mm.
easily.
Would you mind briefly summarizing that evidence, Bob?
We talked about the CPI and the PPI data, and as you can see, quite rapidly, those have fallen. And I think we're going to see in future months them falling even faster.
Mm.
The employment report that we just talked about showed a fall in manufacturing jobs. And if we go to the Fed's own regional banks, many of them do a survey every month. We'll find that, for example, Kansas City's Fed's manufacturing survey has been flat or negative since October. The Dallas Fed survey showed up negative for manufacturing in February and March. The Philly Fed manufacturing survey has been negative and shown contraction since last September. Wow. Richmond since last June, almost a year.
Mhm.
There's a chart here that shows manufacturing's new orders, and you can see on the right-hand side how rapidly they have fallen, and they're now in contraction territory. So it's pretty clear, because manufacturing deals with producing goods, that the goods sector of the economy has already fallen into recession. And I note from the jobs report, from the graph we had up in the jobs report, that all of the positive numbers, or almost all of them, are in the services industries. And and the goods producing industries were seeing negative numbers.
Mhm.
So in the next chart, we show housing and the mortgage refinance activity. And that's off about 75% from its peak, while the purchase apps, these are applications for people to purchase homes, are down 50%. Those are big numbers,
Yeah, that's pretty
and it
big number.
shows that the housing industry is just going to fall off a cliff. So, not going to be a surprise when home sales fall and the prices of homes fall. In fact, we've already started to see that.
Yeah.
Last Wednesday, CNBC headline read, quote, "Inventory gluts are here to stay," unquote. What does that mean? It means that businesses have too many inventories,
Yeah.
and it normally means they get rid of them by cutting the price. Everybody has a sale, right?
Yeah, they have to sell.
Keep on getting emails all over my emails. Come, we're having a sale here. We're
Yeah.
having a sale there. So at least for goods, the goods side of the economy, deflation already appears to be starting.
Mhm.
Let's look at the autos. In March, auto sales fell 1.1%. That was on top of a 6.6% fall in February. And auto sales have been down in 4 of the last 5 months. Now, when people are excited about the future, they often buy a car. When they're unexcited about the future, they don't buy a car. And
Right.
that's what we're seeing.
Yeah.
Same store sales. There's a company called Redbook, and they look at stores that existed a year ago and they compare them to their sales today. In the March period, Redbook found that same store sales were down 2%. So that means the consumer is not purchasing as much. This is a sign that prices are likely to continue to fall. The New York Fed, and this is the next chart, does a, a an index of supply chain pressure. Remember all this talk of supply chains when we had COVID lockdowns, we couldn't get goods, all the prices rose. This particular index is now below zero, and
Mm.
it's softer than at any time in the last 5 years, except for just a couple of months in 2019. Also, if we go back to those Fed regional bank surveys, they ask companies about the prices that they pay and the prices that they receive and how long it takes them to get delivery from their suppliers and whether they have order backlogs. In all those 4 categories, prices paid, prices received, supplier delivery delays, and order backlogs, we're seeing significant softening.
Mhm.
And that implies an atmosphere of disinflation. We talked about housing just a minute ago. I just wanted to emphasize another indicator that I have. For the first time in 11 years, home prices are falling. And as we discussed earlier, rents are continuing to fall too. Okay, so into all that, OPEC decides that they're going to reduce output by 1.2 million barrels per day starting in May. And when they did that, of course, the media got all excited and this is going to cause gasoline prices to rise, more inflation, blah, blah, blah. I don't think that's the way it's going to happen. Now, we just had the IMF tell us that there are many places in the world we're going to see recessions. Those recessions will reduce demand for gasoline and oil by much more than 1.2 million barrels a day. In the U.S., although we initially had prices of uh, on on the on the exchanges, prices of oil went up. I think that this is going to be a non-event. The recession is going to reduce oil demand. I don't think that over the next year we're going to see huge rise in oil and gasoline prices.
Mm.
This isn't something you're going to hear from our media.
We'll see what's happening. Interesting as always, Bob. Would you mind summarizing what you anticipate for the next 6 months?
And the other point, I'll point to a weakening economy and deflation. The bond market has already sensed this. And so we've seen over the past month, yields, interest rates have fallen despite the fact that we think that the Fed is going to raise them. So the Fed, when they raise them, only raises the short term rates. The 10-year Treasury note, which is longer term, it was 4.1% on March 1st. Today it's at 3.45, so quite the fall.
Mhm.
The Fed, even if they raise rates again and on their May 2nd and 3rd meeting, it is going to be probably the last of the rate hikes. And and I think that over the course of the year after May, we're going to probably see them start to reduce rates. Don't forget, and I didn't talk about this, but the Fed considers 2.5% to be neutral. That means that if they're at a 2.5% rate, they're neither easing nor tightening. So they're at 5%. That means in order to get back to neutral, if we have a recession, they'll have to reduce rates
Right,
and have to reduce rates back to neutral.
right,
That's 2.5 percentage points. And usually, if we have a recession, they're going to go through neutral. So we're really here at the height of what interest rates will be. And I think by the time we get to year end, they're going to be significantly lower. So
right.
deflation, in my view, has already begun.
Okay. All right. Thank you, Bob. A great insight as usual. A lot to be aware of or to be reminded of. And also a great reminder that it's important to get the right information from the right sources, just like you. Appreciate your insight, Bob. Thank you so much for everyone. Remember to subscribe to the channel. We post videos on a regular basis. Also visit Hidden Truths that today we have all our blogs and videos and podcasts there. Thank you again for watching. Thank you very much, Bob. Great to see you today.
It's great to be here.